Identity fraud has been around for centuries, but the internet is giving one type of ID theft a boost by giving fraudsters a way to cherry pick info from different people, creating something called Frankenstein fraud.
Banks are approving loans to dead people. Not one case, not two. This is happening at scale across the United States, and AI lending systems are making it easier than ever. Identity thieves are using the personal information of deceased individuals to get approved for credit cards, personal loans, auto loans, even mortgages. And by the time banks realize what happened, the money is long gone. This fraud has a name: ghosting. And according to financial institutions, it's costing them tens of millions of dollars every year. But here's the terrifying part.
It's called synthetic identity fraud. Instead of outright stealing an identity, a criminal makes one up. It's sometimes called a Frankenstein ID. Criminals randomly pick, or they can buy, a social security number. They link it to other fake information, like a birthday, for example, then slowly build credit over multiple years.
It's getting worse as banks replace human loan officers with AI systems that prioritize speed over accuracy. Here's how massive this problem is. The Social Security Death Index contains records of over 83 million deaths reported to the Social Security Administration. That's 83 million identities that fraudsters can potentially exploit. And they do. According to the FTC, loan fraud involving deceased individuals was the 5th most common type of identity theft in 2023. Not 10th, not 20th, 5th. The Identity Theft Resource Center reports that stealing the identity of deceased people can go on for months before the crime is detected. Because there's a critical window of vulnerability between when someone dies and when government agencies and financial institutions actually get notified. Here's the timeline that fraudsters exploit. Someone dies. The funeral happens. The family is grieving. But it takes the Social Security Administration time to process the death. It takes credit bureaus even longer to update their records, sometimes 6 months or more. During that window, the deceased person's credit file still looks active. Their Social Security number still works. Their credit score is still there. And to an automated lending system, they look like a perfectly legitimate borrower.
It's one of the biggest crimes right now and estimated to be a $20 billion industry.
Experts say everyone is at risk of becoming a victim to Frankenstein fraud, but it can take years to realize if you are, and by that point, it may be too late.
Traditional loan officers used to be a barrier against this fraud. A human reviewing an application might notice something off. They might make phone calls to verify employment. They might ask questions that don't quite add up. But AI doesn't ask questions. It processes applications in under 60 seconds. According to banking industry reports, synthetic fraud attempts, where criminals combine real information from deceased people with fake details, have risen 184% in the past 5 years. That's not a typo. 184%. And it's getting worse fast. From 2022 to 2023 alone, synthetic fraud attempts increased 21%. That's the exact same period when generative AI had its breakout moment and banks started aggressively deploying AI lending systems. Here's what the AI checks: credit score, income stated on application, debt-to-income ratio, employment history on file. Here's what the AI often doesn't check: whether the person is actually alive, whether that employment is current or from 3 years ago, whether the Social Security number belongs to someone who died. The Death Master File exists specifically to prevent this. It's a database maintained by the Social Security Administration that lists deceased individuals. Banks are supposed to cross-reference it before approving loans. But according to Treasury Department reports, many AI lending systems don't check it properly. Or they check it but don't weight it heavily enough in their algorithms. Because checking slows down processing time. And speed is what these systems are optimized for. In April 2024, a woman in Brazil literally wheeled a dead man into a bank and tried to get him to sign loan documents. Security footage went viral. She talked to the corpse, addressed him as her uncle, and asked him to sign papers for a 17,000 reais loan. That case was caught because it was in person and completely insane. But it highlights how desperate fraudsters are to exploit deceased identities. And unlike that obvious case, Online applications using deceased identities are much harder to catch. The FBI issued a warning in December 2024 specifically about criminals using AI to facilitate financial fraud involving deceased identities. They're using generative AI to create fake documents, synthetic voices, even deepfake videos to make dead people appear alive during remote verification processes. One Hong Kong company lost $25 million in January 2024 after an employee was tricked by deepfake video of company executives, including a fake CFO, on a conference call. While that wasn't specifically about deceased individuals, it shows how sophisticated AI-powered fraud has become. Banks have reported instances of synthetic clients applying for loans using AI-generated IDs and deepfake selfies of people who don't exist, or who exist but are deceased. These fake identities can trick remote verification systems that rely on facial recognition or document scanning. When fraudsters successfully get loans approved using deceased identities, the money disappears fast. According to financial fraud investigators, the typical pattern is: loan gets approved. Money hits a newly opened bank account. Within 72 hours, the entire amount is converted to cryptocurrency and moved through multiple exchanges. By the time the bank realizes something's wrong, usually when the first payment doesn't come in, the money is completely untraceable. You can't get crypto back once it's been properly laundered through tumblers and mixers. The auto industry alone experienced a 98% increase in synthetic identity fraud attempts in 2023. That's fraudsters using dead people's information combined with fake details to get approved for car loans. They drive the vehicles off the lot and disappear. The Small Business Administration estimates that over $200 billion of their pandemic assistance loan programs went to fraudsters. Not all of that involved deceased identities, but a significant portion did. Criminals used dead people's social security numbers to apply for PPP loans and EIDL funds that were never paid back. AI researchers who study financial fraud point to a fundamental problem. These lending AI systems are optimized for speed and approval rates, not fraud prevention. Banks wanted to compete with fintech apps that promise loan approvals in minutes. So they built AI that says yes as fast as possible. The system is rewarded for processing applications quickly and maintaining high approval rates. Fraud prevention slows things down. Checking the death master file adds processing time. Calling to verify employment takes even longer. So these checks get minimized or automated in ways that aren't thorough. According to an October 2024 report from security analysts, 50% of fraud and risk professionals said their company's synthetic fraud prevention is at best somewhat effective. Half. That means half of these systems are barely working. Legacy passive identity verification systems, the kind that check information behind the scenes without customer interaction, are being fooled more frequently. So banks adjust their risk algorithms to try to catch fraud. But this comes at a cost. Legitimate customers get rejected or face more friction in the approval process. It's a lose-lose situation. The AI either approves too many loans and lets fraud through, or it rejects too many applications and loses legitimate customers. Here's what's terrifying. Most of these cases never become public. Banks settle quietly with estates of deceased people whose identities were stolen. They pay settlements, make everyone sign NDAs, and move on. Industry insiders who spoke to financial media estimate that AI lending fraud involving deceased identities has cost banks somewhere between $50 to $100 million in recent years. But that's just estimates. Nobody's releasing official numbers because it makes them look incompetent. According to Deloitte's Center for Financial Services, generative AI could enable fraud losses to reach $40 billion in the United States by 2027, up from $12.3 billion in 2023. That's a compound annual growth rate of 32%. Not all of that is deceased identity fraud specifically, but a significant and growing portion is. The Treasury Department announced in October 2024 that they prevented and recovered over $4 billion in fraudulent and improper payments in fiscal 2024, partly through AI tools designed to detect fraud. They're using the Do Not Pay service, which cross-checks multiple data sources, including the Social Security Death Master File. This helps agencies verify that they're not sending payments to dead people. The Treasury finally got access to the complete Death Master File on a pilot basis in late 2023 after Congress included it in an appropriations law. Before that, there were restrictions on who could access the full database. But here's the problem. That's the Treasury Department, government payments. Private banks have access to the Death Master File too, but they're not required to use it properly. And many AI lending systems don't integrate it effectively. Some banks are fighting fire with fire, using AI to detect AI-generated fraud. They're implementing machine learning systems that analyze patterns across thousands of applications to spot synthetic identities and deceased person fraud. But it's a constant arms race. Fraudsters get more sophisticated. Banks update their systems. Fraudsters adapt. The cycle continues. Banks are approving loans to dead people because their AI systems can't tell the difference between a legitimate borrower and a fraudster using a deceased person's identity. The technology exists to prevent this. The Death Master File is right there. Employment verification systems exist. But these checks slow down loan approvals. And in the race to offer instant lending decisions, speed has become more important than accuracy. So the fraud continues. Tens of millions of dollars flowing to criminals who know exactly how to exploit these systems. Families discovering months or years later that their deceased loved one's identity was stolen to commit financial crimes. And banks keep using the same flawed AI systems because fixing them would be expensive and would hurt their competitive advantage in processing speed. This is the reality of AI lending in 2026. Fast approvals, minimal verification, and fraudsters exploiting the gaps at massive scale. Do you think banks are doing enough to stop this, or is speed being prioritized over security? Drop your thoughts below. And if you want more AI failures that expose how these systems actually work, hit that subscribe button for AI fails. We're not stopping.